One of the first things that you'll ask yourself when you start looking into stocks is, how do small companies actually finance their projects and start to build a company? Well, today we're talking about how companies raise capital and the different ways that they do so. How's it going, guys? Ryan here, and welcome back to another investing video. And today we're talking about how companies actually raise capital in order to finance their operations and their projects, especially those which are small and just starting out, that have nothing that is generating value. But before we get into that, guys, please remember to give this video a thumbs up. It helps me out so much with the YouTube algorithm. And if you do enjoy stock market investing or wealth management content, hit that subscribe button for more of that. I'd love to know your thoughts on the different methods after you've watched this video of capital raising that companies undertake. And with that, guys, let's get straight into the video. Now, companies obviously need money in order to operate, in order to grow, in order to finance projects and just their general operations. But how do smaller companies that don't have any real source of income actually get off the ground? Well, there's actually a few different ways. And if you're looking at companies such as Tesla, they even themselves are still undertaking these sorts of things, even though they are an absolute gargantuan of an organization. The three key ways for doing this are retained earnings, debt capital, and equity capital. And I'm going to go through each of those different forms of capital raising right now. So let's kick it off with retained earnings. Now, this is the most obvious one and doesn't apply typically to these smaller companies, but it is retained earnings. Now, retained earnings is effectively the amount of money that companies are making after they've, deducted all their costs of operations, cost of production, cost of sales, all those sort of things. It's the money they are left over with afterwards. A lot of companies issue these, especially if they're larger, as dividends, a portion of their retained earnings. But typically when you are a smaller organization, a medium organization, or even some large organizations, the primary source of capital in order to fund projects, fund operations, pay staff, all those sorts of things are retained earnings. Now, this is very important because it is one of the main ways for companies to obviously fund things. And in fact, in my opinion, it is the best way. Making money on a product, on a service, on anything that this company is doing, whether it be mining, whether it be oil and gas, whether it be social media, whether it be tech, whether it be, weed stocks, whatever it is, a company needs to generate money. So the plan of an organization should always be to use retained earnings either down the track or at the current point in time in order to facilitate all their projects going forward. And in absolute basic terms, retained earnings is your profit. Simple as that. It is your profit, is your money that you can take away after you've produced something or provide a service and then reinvest back into the company. The second way that companies can raise capital is through debt. And debt is effectively the same as it is for an individual. It is in the form of a loan, whether that be from a bank, an institution, private lenders, whatever it may be. A company, much like an individual, can take a loan in order to finance projects. And for smaller organizations, this is typically one of the more favored ways to go about performing projects. Now, obviously, if you're getting debt in order to finance your, day-to-day operations in the sense of paying your staff and all those sort of things, that is bad. You do not want to invest in a company which is doing that. But you want to be looking for companies where they are borrowing money at a reasonable rate, that they have a logical plan and payback period in place for, so that they can facilitate their projects. Now, one way you see this is often through small mining companies. And obviously for a lot of mining companies, it is going to cost hundreds of millions of dollars in order to set up a mine or set up an oil and gas plant. Any of those sort of things are incredibly expensive to do. So it's critical that when they take on a vast amount of debt, they have the ability and they have that plan in place in order to pay back the debt, not only the interest, but obviously the principal as well. And more often than not, you see many companies go bankrupt, which are small, just purely because they are unable to facilitate their debts. So make sure you steer clear of these. I myself have personally been burnt from these sorts of situations where the company I've invested in simply could not pay back the debt. As great as they were from an operational perspective, they were just unable to financially stand on their own 2 feet because they were a small junior miner. The third way of raising funds is through issuing equity. Now, issuing equity is effectively typically where a company will issue shares to, whether it be retail investors, so people like myself and yourself, institutional investors, which are those, larger sort of organizations, or sophisticated investors, which have typically individuals with just large amounts of money. Now, effectively, this is a form of capital raising because what they do is they go out to market or they go out to an individual and they'll say, hey, we'll give you a bunch of shares for a X amount of price, and in return, obviously, they're getting that money immediately and they're able to raise that capital. Typically, when these equity issuing events occur, they are known as capital raises. And when the capital raise occurs, it is typically at more favorable terms than the current share price. Or alternatively, it is in the sense of it's using a weighted average of the share price over a period of time. So whether that be 15 days or 30 days or whatever it may be, these terms are negotiated in that capital raise agreement that occurs between the stakeholders from the, equity providing side, so your institutional investors or your retail investors or whatever, and the company itself. If they're going out to market for, myself and yourself and all those sorts of people, your retail investors, they will issue the terms, and it's your choice as an existing shareholder if you want to get involved in the raise, or you can just avoid it. And typically they'll often offer things up like options so that you can potentially convert them into more funds further down the track. But if they're going out to the likes of a sophisticated investor, either they can elicit these quotes from themselves, or they are typically as well approached by sophisticated investors if this company believes that the stock or whatever the company is you're invested in is likely to increase in value, and it's a good way for them to get a stake in the company. One of the key elements to note here is there are, good and bad elements of equity raising. And the first thing I'd like to touch on is the fact that if you issue more shares into the market, that means it dilutes the shareholding for existing investors. So if there are 1 billion shares on issue for a company at a price of 10 cents, for instance, that is then diluted significantly if another, let's say, 200 million shares are issued to whether it be sophisticated investors or retail investors, and it will likely cause the share price to drop. Now, in saying that, this may be a good thing depending on, as I said previously, what they're using the money for. If they're using it just for day-to-day operations, that is absolutely terrible. But if they're using it to finance a project which will effectively allow them to, double their revenue, for instance, then that is fantastic. But you got to keep back of your head that this is diluting the existing shareholding, whether that be a good thing, whether that be a bad thing. That is up to you to decide as an investor. What I really do prefer about this form of raising capital is the fact that the company isn't taking on more debt. So for instance, if a company, as I mentioned before, takes on debt and all of a sudden they are unable to pay it back, they're going to go bankrupt. As opposed to a company which is issuing capital, they're not going to go bankrupt because they're having to pay back loan repayments over time, and there's more money that's actually retained in the organization because there's no interest element involved at all. Obviously, the share price is likely to be diluted by the more shares on issue, but there is no risk of what you have when you have debt capital raising, where you could have a company which is going bankrupt because they are having to pay interest that they just cannot afford to pay. Obviously, in an ideal world, retained earnings is the way to go. If you're invested in a company that is making a profit and can put that back into a company, that is fantastic. But for those smaller companies, particularly if you're investing in the micro cap, the small cap space, they are going to need to raise money somehow, and they'll do that by either going to a loan or issuing equity to various stakeholders. And with that, guys, I am wrapping up today's video. I hope you did enjoy it, and I hope you did learn something today. If you did, please remember to give the video a thumbs up. It helps me out so much. And subscribe for more investing, stock market, and wealth management content. I'd love to know your thoughts and your perspective on each of these different elements of raising capital down in the comment section below. And with that, guys, I hope you have an awesome day. I'll see you next time. Cheers.